We don't even know, Patrick. I might actually be an artificial intelligence right now. You don't even know if you're talking with a real me.
That's what you are, AI. Oh, I knew something was up.
I am AI.
Ladies and gentlemen, welcome to another episode of Rein It In. Today, I don't have 7 or 8 or 9 sticky notes, Patrick. I only got 3. But there are 3 very, very impactful topics. We're going to talk about leading indicators that are happening right now in the business outlook, as well as in the real estate segment. We are going to talk about BC's Homes for People report they just put out. I know you have lots to say about that, so that's going to take up most of the show. And then we're also going to talk about some interesting market indicators that are actually showing some positivity around rental housing providers. So stay tuned. We got some good news, we got some interesting news, and we're going to dive deep in this episode of Rein It In.
So JG, before we get going, we got great topics. We're going to have a great conversation. You know, we got to ask our listeners to subscribe. We've got these listeners and we got these views, but we don't have subscribers. So please, if you're listening to this, you get some kind of value, some kind of entertainment, please subscribe, like, comment, let us know what you like, even what you don't like. But let us know one way or the other, and be sure to subscribe. We got to get the subscribers up.
I agree, Patrick. Whether you laugh with us or laugh at us, we don't care. We just want you to subscribe. So subscribe, like, comment, and we'll see you continue to deliver this kind of value. All right, let's start this awesome show with actually talking about some leading indicators, Patrick. We got, by the way, for the whole show, we only have 3 topics, but we have 11 different charts we want to show. There's quite a bit of data happening. There's quite a few charts to dig into. And this show, compared to others, is going to be, I don't want to say less ranty, because with you, Patrick, it's always more ranty. But definitely we're going to dig into some charts for sure on this one, starting with this particular chart on the Business Outlook survey. This is for the first quarter of 2023. And this really just shows in terms of where things are heading. In terms of prices are coming down, credit is also coming down, sales are coming down, capacity is where capacity is, but investment and employment is up just marginally. But you can really see that trend, Patrick, how we really crested. We ramped up in 2021, peaked in 2022, and now we're on our way down. The question is it going to keep going in this direction, or are we going to start going back up? Time will tell.
Well, we have to unpack those charts just a little bit, because one of the things that have dropped, for example, what brings some of that down is, I'm going to give you an example of some kind of deflationary things. Prices on televisions are down 80% from some of their highs. So when we break these charts down and we look at what's happening, there's growth and increases in some, but a real offsetting decrease in others. So you have to look at sectors within those charts. Here's the thing about it, is that from a business optimism point of view, this whole business survey that they did shows that businesses are a little nervous. Business confidence is also being soft. Borrowing costs are increasing. Labor still continues to be a bit of a challenge. And then some of their costs are escalating in behind the scenes. All to say this, is that the trend isn't really, really bad, but it's certainly not overly optimistic. It's kind of really flat, which is kind of in line with what we see GDP doing over the course of the rest of the year.
One of the things you notice from this chart that really stands out to me is look at the orange section, which is capacity. Capacity is essentially all out of the system now. You saw a lot of capacity that was built up essentially in 2021, 2022. There's no more capacity left in the system according to this chart. And this is only one chart. But it's interesting, Patrick, because this is really what we're trying to bring to the show here is some components of leading indicators, trying to look into the future without necessarily just looking at the past and saying, where's this stuff heading? That's why we're showing this particular chart, which I think illustrates that really well. The other chart that I want to share, and then we can kind of bring them together, is these kind of concerns that the average business sort of, if you will, are concerned about. And there's some interesting things. Number one is cost pressures. If you look at this chart, cost pressures, in terms of the concern, which is the orange bar, 2023 Q1, they're a little bit more concerned about cost pressures this year. Not too much. Labor shortages are less of a concern right now than they were last year. If you also look at uncertainty's up this year compared to last year. Sales, again, are up this year compared to last year. Supply chain concerns are way down, so that's good. Supply chains are opening back up. But one of the things that we're seeing at the top of the concern is credit. People are concerned about credit, but it's less of a concern in the first quarter of 2023 than it was in the last quarter of 2022. And the reason for that is because interest rates have peaked in many people's minds. So credit is less of a concern. I'm curious, Patrick, regarding credit, how people are going to feel about it at the end of Q2, given the bank failures that happened throughout March.
Well, all indicators. So I look at this as a bit of a leading indicator for us. As investors, what are we trying to do? We're looking into the future. We're looking at the economy, where we think it's going. What's the impact on housing? Because if you listen to the narrative that's happening in the bearish Twittersphere, which is a really big component of what drives some of the headlines even, is we look into the future and it's all bad news. There's a bubble, it's this, it's that. Now people are really confused because there's multiple offers on really well-priced properties. There's not enough real estate. It's all to say this. Let's just narrow it down and say, where do we think the economy is going? And we look at leading indicators. And I think this business survey is one of those. The people that are in the trenches are not looking at it overly optimistic, but they're not ultimately really bearish either. So as long as business is happening, jobs are going to continue to happen, money's going to continue to flow into the system, all good news, positive news in the world of real estate.
Absolutely. And there's actually more positive news to come, which we'll talk about in the next segment of the show, where there's some very interesting trends that are happening for rental housing providers. And we'll be sharing some charts around there. Now, Patrick, do we want to jump into and talk about the BC Homes for People? This is a recent report that was put out. Very, very fascinating in terms of what was put out. And I'm kind of curious, Patrick, your thoughts on this. This comes on the heels of Ontario pushing through the legislation they did. Is this a bit of a reaction by BC in order trying to get ahead of what, or trying to follow up on what Ontario did? What's your thought on kind of the positioning of this BC Homes for People? And then we can dig into the report because there's a lot going on there. Some good, some not so good.
Well, the report cracks me up. Homes for People. Good to know that it was for people and not for something else. I don't know what it would be. Homes for pets. I can't imagine what it would be. But the point is this, is that the report itself is, I think it was 32 pages. I reviewed the report, and it's really light on any kind of, content that is meaningful. It's a real strong overview, lots of fluff, lots of rhetoric. So the report itself is not that great. Now, a couple of articles have come out where Premier Dave Eby was interviewed. And I have to be honest with you, it, as always, is light on any kind of execution plans. So it talks at a high level, we're going to build more real estate, more affordable homes, all of the stuff that they want to talk to. That's the politics side of it, but I don't see them executing. And there's one particular piece, JG, I sent you the note on one of the Dave Eby quotes that just fired me up, which was, this is an indication of where our politicians are. And why don't you just take a minute and read that quote, and then you'll kind of relate to it better. Or we will.
Well, the quote. There's actually a lot of things in this report I want to read, yeah. But in order to not keep people waiting, I think the quote that you're talking about here is the component about this where it says, this is quote from the report, we still need to invest massively as well in public rental housing, so landlords are no longer able to charge such ridiculous rents on their second and third income properties, and we need to focus on building pleasant missing middle density so people don't think they're forced to choose between a spacious but unaffordable single-family home or a concrete box in the sky.
Here's the fundamental problem that you hear that quote from Dave Eby, and it's the problem that we see right across government. They're implying that it's the landlords overcharging for rent, which, I guess there's always a scenario where people will take advantage, or there are those landlords who are taking advantage of a very low vacancy rate, no doubt about it. There always is. That is not the norm. That's the exception, but he implies it's the norm. He doesn't address the fact that, number one, interest rates have gone up, insurance costs have gone up, and oh, by the way, talk about Vancouver, BC overall, and the property tax increases that have come up, and all of a sudden he's saying we're overcharging as landlords. It just fires me up. And primarily it fires me up because it just shows how much, number one, politics over policy is going on, or how out of touch our government is with what the reality of being a rental housing provider is. And by the way, they've got a rental housing shortage, so don't be trash talking landlords or making them wrong, because they're actually what is providing the housing. So when a politician makes that kind of a statement, it just drives me kind of crazy, because it really isn't true, number one, and there's no substance behind this statement. Because if they're going to provide this kind of idealistic environment for rentals, it means that there's got to be some rental affordability, and ultimately, what are they going to do? Subsidize it, which then the taxpayer is going to carry. So it's all just out of touch with the reality of, I think, reality of business overall is what I find in general with politics. But anyways, that particular statement is really indicating to me that we are not going to look forward to any great success in terms of the program that he's offering.
Well, I agree with you, Patrick. I mean, the way that he set that up is just, baloney in my opinion. I got stronger words than that, but I'll reserve them for off camera. But here's what I will say to someone listening to this show. If you're a rental housing provider, number one, you shouldn't let this kind of stuff worry you. And here's why. The reason, Patrick, is because we know politicians make this kind of stupid promises, and they say these kinds of things to appeal to the masses, which the masses don't own real estate in their landlord kind of rental housing provider way. And they're trying to appeal to their voter base. They're trying to get votes. That's why they say things like this, even though, quite frankly, we both know it doesn't make any sense whatsoever. Because let's just break it down, Patrick. If you ask any landlord, any rental housing provider in BC, hey, how's your cash flow on that property? Most of them are cash flow negative. They're losing money every single month in order to provide people with housing. And this guy has the audacity, I was going to use a bad word, this guy has the audacity to say stupid stuff like this, when in fact, you got these landlords that are actually losing money month in and month out to provide housing. So that's the real reality of what's happening out there in BC and in parts of Ontario. So, I just want those that are in the game like you and I are, Patrick, not to listen to this stuff. It could be very disheartening for some people to read stuff like this. It's not the reality. This guy's just trying to get reelected, and hopefully he doesn't.
Yeah, and I think we can go on to the next part of this, because I think there's some substance in here that, we can talk about what they are doing that I think is some positives moves that they're going to make if they pull it off.
I'll go into a couple of things to give some context, Patrick, and then you can give your thoughts on it, which is they're following suit, in my view, what Ontario did, except they're going a little further. And that is, in Ontario, we passed legislation that any property, you can add up to 3 units now. You can have a single family, a duplex, or even a triplex, including coach homes. You can do that in Ontario. They're doing the same, but they're actually going up to 4 units. That's what they're proposing, is you can go up to any 4 units on a traditional single family detached. That's fantastic, Patrick. That provides an incredible amount of density and really good options for us as real estate investors. And I hope that part of it goes through. Now, there's a lot of parts of this report where they say things like they're going to make it easier for secondary suites. How they plan to do that is always the devil's in the details, as you know, Patrick. But there's many parts of this report which are actually quite good. It all depends on how it's going to be executed. And I don't know if the report specified that, Patrick. Is it going to be legislation? Is it going to be passed legislation like it was in Ontario, or is it going to be different?
Well, yes, it's got to be passed. So this is suggested at this point. This is on the table. It has not been passed, and they do have to pass it. And, in order to take that residential, that single family, and turn it into a multi, they actually have to, of course, make sure setbacks are all right and the footprint, the envelope is right. So there's still lots of conditions that go with it, yet to be determined, but they're talking about having that all in place by, I believe, late summer, and starting to move forward in building some stuff.
There's also another part of this, Patrick, I want to read, because these are the parts that this may not make any sense whatsoever for a lot of people. Some people may want to take advantage of this, but the report says, beginning in early 2024, homeowners will be able to access a forgivable loan of 50% of the cost of renovation up to a maximum of $40,000 over 5 years. Over time, the loan can be forgiven if the homeowner meets all conditions laid out in the program, including renting the unit at below market rates for a minimum of 5 years. Now, before you freak out, Patrick, and I know what you're thinking, because I think the same, but the devil's in the details. Sometimes they say below market rates, and their market rate is way above the actual rental rate. And just by being a little below that, you can qualify for this kind of program. So it's kind of funny how they put these words on paper, and often it means very little until we get all the way down and see what the brass tacks is. You see what the actual details are. But what are your thoughts on that, Patrick?
Well, I mean, as you say, we know that, why would anybody in business other than government, do that? Why would they give up 5 years? And who's setting the rate, to your point? And, they did a similar program. I don't want to say similar. They did a program in Edmonton a few years ago. It was $20,000, totally forgivable, but you had to rent to what they call low income or lower income, which I think they set the bar at 50 grand. I don't remember the exact number. The point was this: number one, you couldn't find anybody that was making less money than that, so you had trouble renting it out, and they had to have income verification in order for you to get that 20 grand back that you put into it. And so there was troubles with that, and then ultimately you were attracting a tenant profile that didn't fit, for example, in the neighborhood that you actually bought your single family and put a basement suite in it, and therefore you were attracting a tenant profile that just wasn't good. It wasn't a healthy tenant profile, I'll use that term, because, and they were too low of income, so they were struggling all the time. They were on some kind of government support, whether it be welfare or whatever. But the point is this: is that these programs are brought from government bureaucrats that don't actually listen and have conversations with the people that are in the trenches. That's always the problem with them. So, what have I got to say about that? I think it's, the devil's in the details, as you say. We'll see what they have to offer, but I'm not optimistic.
I can tell you that what's happened in Ontario, speaking from experience, is, and listen, the legislation Doug Ford passed was not perfect by any stretch of the imagination, but it moved Ontario forward meaningfully in terms of allowing us investors, and it gave us some other tools in our toolbox with regards to the coach homes, with regards to the ARUs, with regards to these different bylaws that are being passed now. Definitely, it's been a positive move forward. Is it perfect? No. Has it helped us? Definitely. And I hope the same happens to BC.
Yeah, I agree. I hope it does. But again, all these housing programs that they're offering are going to be, they're going to be lag time. It's going to take some time for it to all happen. So for some, it's going to be beneficial. I think that it isn't going to solve any problems anytime soon. And already some of the government's starting to back off on some of the numbers that they were saying that they're going to achieve, like 150,000 new homes in 10 years. And they're realizing that there's no chance that that's going to happen. So these are all things that as investors we have to pay attention to, because if we want to get into it, like if we're going to play the game, we have to know what game we're playing and understand that some people will say, well, if they're going to be building all this, there's going to be too much supply. Are we at risk of that? And that may have some investors actually kind of back off a little bit. And my experience is, and what we're seeing so far, is the government is part of what caused, or most of what caused the problem. So they're certainly not going to be those who solve the problem.
If anybody's listening to this show and truly listening, they should not be afraid of too much housing. They should not be afraid of an oversupply, because even the promises, Patrick, of 150,000 new units built for the next 10 years, which is 1.5 million units, we've shown with data, with numbers, that we're doing that right now. There's no new supply there. Like, that's already our average. That doesn't fix the problem. In fact, as immigration continues to go up, it only gets tougher and tougher and tougher. And you could see that with this year's supply numbers in terms of our spring market. We're at an all-time low in terms of listings on the market. All-time low, 20-year low. When I say all-time, 20-year low is what I mean. That's just an indication of where this is heading, which is it's not getting better yet.
No, it's not getting better yet. So this is where we go back, JG, in terms of what's happening in the market. We're seeing the market start to pick up, although listings are still very low. People are actually out spending. They're actually getting mortgages. They're buying homes. Mortgage rates have kind of stabilized given the bond yields. And all I've got to say is that we've been talking about this for months. Through this whole thing, we said there's opportunities. That's why we, bring Barry McGuire in to talk about creative strategies. We need to, as investors, we need to kind of embrace that and take advantage of this market right now.
If you look here, we're putting up this chart called Sellers Are Still Hibernating, and check out that blue bar, 2023, just over 50,000 listings. And by the way, this is not seasonally adjusted. These are the February new listings. Still way down, Patrick, way down from 2022 at 70,000. 2021 was just about 70,000. So there's still lots of room to go in terms of supply, not to be a concern at all. And if you look at Toronto, it's no different. I mean, Toronto in itself separately, again, way down in 2023.
Well, I think, and we can't step over the fact that what this continues to do, and this is just one component of it all, what it continues to do is drive rental demand. So, having said all of that, as rental housing providers, we need to be that space for people to move into and invest in real estate and get those rental properties out there.
Well, we actually moved in. Oh, geez. I just noticed I still got 3 sticky notes on my desk, Patrick. We've already covered 2 topics, so I got to start throwing sticky notes at the camera. Hold on. Here we go. Here, that was the first one. Here's the second one. Now we're on to the third one, which is some very, very interesting market indicators. That's what we're talking about now. This has to be viewed, Patrick, and we talk about this all the time, but this has to be viewed from a rental housing provider perspective, not a consumer perspective, not the average mom and pop perspective. As a real estate investor, if you look at the fact that supply is low, this helps you. This helps your rentals. If you look at the fact that we're at a 20-year low for supply, a 10-year low in Toronto, all these new listings that are not coming on the market, this is a good thing for us as rental housing providers. And we have more of these numbers too, Patrick. Whereas if you look at this chart, where in Toronto, buying compared to renting, and if you look at how, back in 2020, it was marginally better to rent than to buy. Just almost even, but marginally a little bit better, a little cheaper to rent. But then look what happened in 2021, 2022, and buying has just gone out of control. It's become way, way more expensive. Now, for the average person that wants to buy a home, this is not good. It makes it more difficult for them to buy a home. I understand that. But as a rental housing provider, what this does is it opens up my market and it provides me a fantastic renter base that are going to rent instead of buying. This is good for me as a client. It brings me a better client as a rental housing provider.
Well, I think you just nailed it, right? It's a better demographic generally because, it's the household income is higher, and that household income is higher, but that doesn't mean they can qualify for a mortgage or they can come up with a down payment on these particular properties. And now there is definitely a movement, if you will, where people are going, no, I'm not buying a house. Even if I can afford it, I'm not going to pay these prices. I'd rather just rent, use my cash flow in terms of lifestyle and not worry about buying a home. Now, if you read the headlines, it's like everybody wants to buy a house. That's not the case. And that sentiment is starting to change. And although it's anecdotal, they're starting to actually put numbers together to in their polls or surveys to what degree you want to believe them. But at the end of the day, people are going, no, I'm not going to pay a ridiculous amount for this house. I'll rather rent. But gives us is the opportunity to have a higher household income renter base. And mostly that's going to be good.
Absolutely. And Patrick, this has been a trend that's been ongoing at the Real Estate Investment Network. We've been talking about this since like 2015, how the millennial cohort was indoctrinated to rent, not buy as much. And we've seen a big change. I mean, back 10 years ago, 70% of our country purchased, 30% rented. It's already down to 60% purchase, 40% rent. That's a 10% variance. That's a huge shift. And that's only in the last 10 years. We expect that's going to continue for us rental housing providers. This is a good thing. And I'm showing this chart here, Patrick, about that Toronto buying compared to renting. But it's not just in Toronto, by the way, because people are thinking, well, that's just in Toronto because it's so expensive to buy. But look at Montreal. The number is exactly the same, or the spread is exactly the same. The numbers are different, but the spread is the same. The one market where the spread is different is Calgary. It's actually more expensive to rent in Calgary than it is to buy, Patrick.
Yeah, something, and that's the case for a lot of places in Alberta. Edmonton will even be, that chart will be even a bigger spread. We don't see that chart. I wasn't able to find that chart, but ultimately that's exactly what's happening. And it's also one of the reasons that we, suggest to investors to keep looking at the Alberta market because that's where some opportunity lives.
Now, I know you're dying to talk about some of the geopolitical stuff happening with the BRICS nations compared to the G7s. We'll get to that in a second, Patrick. I just want to keep spreading out some good news here because we have a little bit to talk about. And that is, I'm putting up a chart here about the real estate sentiment is on the rebound. You can see it has bottomed out at the late 2022, and in 2023 it's starting to rebound. Is it going to continue its trajectory? Time will tell, but right now the sentiment towards real estate is improving in Canada, and it's posted the sharpest 3-week increase since the lows of 2020. Also, the housing market is perking up, and that is measured typically by the sales to new listings ratio. And this has definitely improved. It's improved a lot over the last 6 months. So it may, and this is what we've been saying, Patrick, from the very end of last year, we said, or let me restate, I specifically said, the bulk of the downturn in real estate has happened. You should not expect a huge market correction going forward. It's already happened. This chart is an indication. See that pretty massive drop, and now it's starting to rebound. So that's some good news. And the last one, and then I'll let you speak to all these, Patrick, is there is record low mortgage delinquencies. Now, I know that everyone in especially real estate investors have been thinking, when are we going to see these mortgage delinquencies with interest rates rising, with the market downturning, all the various things? When are we going to see these massive mortgage delinquencies? Patrick, they're not showing up at all in the data so far.
So there's a couple of things on this. Number one, when we look at the uptick in sentiment, guess what? Finally, the Bank of Canada says we're going to pause rates. So there's that fear of big, massive increases in mortgage rates have kind of come off. That is apparently off the table for now. So that gives people some confidence in that sentiment that they go, okay, I can get a mortgage. Bond yields have come down, so that 5-year fixed term has come down a little bit, more reasonable. Still hurts a little bit compared to 1.5% or 2%, but ultimately people can handle it. Getting some supply would be helpful. Plus, spring is in the air. We know that the spring market is always a little bit more buoyant, if you will, and people look forward to getting outside, getting into the housing market. So I think that's all pretty kind of, you can think through that and see why that's happening. On the delinquency side, what's interesting about it is the banks are bending over backwards to support those individuals, those homeowners that are in trouble. They're extending amortizations to the point of even negative amortization, which is all to say this, that it's still, I think there's lots of optimism there, and the banks are doing that. Maybe they're taking on the risk, but it's also because I think they see the future differently and they're willing to take it on. Number one, they don't want to own the homes, got all of that. And certainly with all the controversy around banks, Canada is not in the same position as the US banks. I think we have to point that out, remind people that yes, there's always a risk in banking, and TD is being shorted, and there's all sorts of controversy around it. But to your point, JG, I think there is optimism in the air, some hope, if nothing else. We can all kind of use a little bit of hopium these days, and move forward in that housing market side of things. So I think that's really not much more to say about that, other than things are just shifting. It isn't the doom and gloom. The Bank of Canada, what's Tiff going to do? What is he not going to do? I mean, all of those things were shutting down the market to a big degree in terms of sentiment.
So that, my friend, is some interesting market indicators for us real estate housing providers, and how this is, things are trending in the right direction for us as rental housing providers. But Patrick, I'm writing it down right now. I'm adding a fourth sticky, which wasn't in my original show notes, but I know you're dying to talk about the geopolitics of it all. I know that Acorn has recently put out a chart showing how the BRICS countries are actually going to take over the G7 countries as a percentage of GDP in terms of a global share. That's very interesting. Why don't you touch on that as we wrap up this show?
So the only thing I want to add is that to the segment we just did around sentiment is consumer confidence is quite low. And I would say that it's low, but it's more about being cautious given what's happening. As we come out of a funk, people have to gain some confidence again. I won't be surprised to see it tick up a little bit more over the next couple of months. I just wanted to comment on that. Having said that, when we look what's happening with BRICS, Richard Diaz with Acorn, he's been on our stage. I've talked to him many times. I've had him on my podcast. He's a great analyst and economist. And, he points out that, again, the BRICS is overtaking G7 in terms of GDP output. And so they're growing, and it is a growing movement. Lots going on in with what what's happening in the oil world, because United Emirates or OPEC, Saudi Arabia, China, Russia, they're all kind of hanging out together. Japan just recently bought some oil and natural gas from Russia. The thing about that is they did buy a lot, but it's to say, it's almost becoming an East versus West. They're kind of picking on the U.S., if you will, primarily. Canada doesn't really matter in the big picture, but really what you're seeing is a lot of controversy and a lot of things that are happening in the background where BRICS is actually growing. I think there's 16 other countries that want to be part of it, including Japan, who's now put up their hand, and surprisingly and interestingly is Mexico. Now, Mexico is wanting to join BRICS, and that would be a real shot. I don't think it's going to happen. I think it could happen over the next couple of years, but given that they have an agreement with Canada and US, it would be a big move for them to go over there. So these are things that we're watching, and if there's a risk to a market, I think that could be it. But at the other side of that, I think you're going to see oil go up, and there's some debate about that because OPEC recently cut back oil production, and that can be a couple of different things. That could be them playing hardball with the US, but there's another part of that, which is to say they're front running where they think the global economy is going. So in other words, they could be seeing a global recession, and they're going, we're not going to need as much oil, and they're going to cut back. So there's two conversations going on in that regard. So when we look at leading indicators, what we're trying to do is, again, look into the future, see what's going to happen economically. And these are some of the things that I take into consideration and that I want to share with listeners.
Maybe, Patrick, OPEC have been listening to Rein It In, and they know of the EV revolution that I've been talking about that you don't believe in, and they are just getting ahead of that wave. That's what I think is happening.
Yeah, well, it's not that I don't believe in the EV revolution. I think they're going to force it down our throats. I just don't think it's going to come at the speed that you think it might, although it's certainly happening. There's no doubt about that. Stephanie just got back from Japan.
Why don't you go ask ChatGPT, and we'll see how fast it's coming.
Oh, ChatGPT. So anyways, I'm saying it's coming. I just don't think it's going to be as fast or as robust as people think it is. That's just my view of it, and I have lots of argument for that, not for this show. But Stephanie just got back from Japan, and it was very cool. She jumped in a self-driving bus. She was the only one on a probably 30-passenger bus that took her from the hotel to the airport. And you got to go, wow. No people.
Patrick, I was in Vegas last week, and the hotels now have driverless, self-driving cars that pick people up from the airport, drive them around, so on and so forth. It says right on the side of the car, driverless, self-driving. It's obviously part of a pilot program. But I'll tell you this, Patrick, I took a dozen Ubers while in Vegas last week, and half of those Ubers, were Teslas. And I asked people their experience with, like, what is it like having a Tesla, driving Uber and putting on so many miles? Interestingly, they said their costs have been cut by a factor of 80% because they went electric. Yeah. Incredible gains. And that's why it's only going to happen even faster than I've been saying.
Yeah, maybe.
I just like throwing stuff at the camera. Well, folks, I hope you've enjoyed that episode of Rein It In. I know we didn't cover as many sticky notes as before, but we dug deep. We had 11 charts to show, and it was some great detail. There is some good news on the horizon and some interesting opportunities coming your way. So hopefully you tune in again for Rein It In.
So if you got any kind of value or entertainment out of this show, we work hard. So make sure you subscribe, like, comment. We got to make the algorithms happy. So please subscribe, hit the bell, notify. Then you'll know when we're coming with more. If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.
Maybe we should do a dance party on the show one day. If you want to see more stuff like this, click there.